The ancient Minoans learned in 3000 BC that stars could be used to navigate their world. They understood that based on the positioning of the stars relative to each other, they could determine the direction they needed to travel. Many wholesale and retail merchants felt they understood the rules of profitability until recent issues with factory and retail shutdowns, late WIP, carrier shortages, and port issues threw many organizations' supply chains into chaos. Like a football coach starting with a new team, we are going back to the fundamentals and discussing how managing your inventory and profitability based on merchandising principles will bring that world back into focus for your team.
Classification of inventory is essential because the classification determines the management rules that apply. While there are plenty of subclassifications, there are two basic types of inventory. The first is seasonal or fashion inventory. This is inventory that is expected to sell within a specific period of time. The second is replenishment inventory that is carried year-round for multiple years. The thought process for managing fashion seasonal inventory is to sell the inventory as fast and as close to full margin as possible. That starts with developing a plan that sets sales expectation and monitors sell-through and markdown milestones. Adjustments based on what's happening in your current environment are essential to your success. Where the sales pace is below expectations, it may require moving up your markdown schedule to sell through the product within the designated window. Selling within the designated window is important because it saves carrying costs and clears the floor, making room for the next product, which gives the new product a better chance of meeting your margin goals. Where the opposite is true and your sales pace dramatically exceeds your plan, you can definitely slow the markdown schedule and bring more like product in faster to take advantage of the trend. If selling as much product at full margin as possible is our goal, then why would we even have a markdown schedule? Monitoring sell-through is a very important part of profitability, and adjusting the markdown plan to make sure you end the seasonal window with the smallest amount of product is essential for profitability. What else can be done to maximize the margin of every sale? It is important to limit size runs on everything but the strongest colorways to reduce what ends up on the clearance rack. That means you may offer a full-size run of the basic black dress, but the fuchsia with green polka dots only gets the best-selling sizes. With all of the issues leading to products arriving late, it is more important than ever to make sure the start ship dates from wholesale companies to their retail partners are aligned with when product arrives in warehouse. Well-run wholesale companies target shipping 60 to 70% of all fashion seasonal product in the month they receive it. Late arriving product throws a huge wrench into this plan because 70% of an order may be in warehouse while the other 30% is stuck elsewhere. This is where the better sales teams are consistently working with their retail partners to advise them up to any delays. The better the communication, the better the probability that the retail partner will allow for the shipment to be split so that the ready product can be shipped. The best sales teams will treat this as an opportunity to sell in additional available to sell products that can be submitted until the remaining product arrives. This is important because when the retail partner develops their sales plan for the following year, they will use the current year's receipts from their wholesale partners, and every little bit helps. Unless you are selling wine, your product isn't likely getting better with age. When a product is performing exceptionally bad, unless there are external factors influencing that trend, then Merchandising 101 dictates that the product is marked down until the sales velocity reaches a level that it can be sold within the seasonal window. Otherwise, poor-performing products end up as sediment at the bottom of the open-to-buy, which can destroy your profitability over time if not addressed. The thought process for managing replenishment inventory is a bit different, but it too starts with developing your sales plan based on expected demand. Unlike fashion seasonal inventory, all replenishment sales are expected to be at or very close to full margin. Setting the target margin percent is the starting point to determine if the product qualifies to be a replenishment product. In this chart, we show a wide range of margins from high to low for targeting margin percentages and what the minimum acceptable turn rate is to achieve profitability goals. As an example, we chose 55% as the targeted margin. That was plugged into the sales plan, which also accounts for the minimum order quantities and safety stock to project the expected turn rate for this product at 3.29, which is a full turn better than the minimum turn of 2.05. That means the basic requirements are met to manage this product as replenishment inventory. Once the sales plan is agreed upon, it's important to monitor the actual performance versus the expected performance to understand as early as possible if there are any actions that need to be taken. That starts with reviewing the information by customer. Larger customers should have a replenishment forecast for themselves, while smaller customers can be lumped together with an estimate of their overall combined demand as shown with the miscellaneous customer at the end. Overall, we want to see the actual sales are in line with the replenishment forecast, and at a customer level, while you don't expect the actual sales exactly to match the revenue forecast, we do want to understand any variances that are much higher or lower than expected. This is where communication between the sales team and the retail partner is essential. In the highlighted example, Kohl's has exceeded the replen forecast by 25.9%. Understanding the reason helps determine the best course of action. In this example, the sales rep reported that the customer added doors that carry the product, which means we need to revise the forecast for Kohl's to more accurately capture future expected demand. The same is true when sales are outside of your range of reasonableness on the negative side. In this example, Nordstrom missed their forecast by 25%. The sales rep reports that the Nordstrom planner is on maternity leave and they have not had time to place replan orders, but the product is performing well. Luckily, Nordstrom is a retail partner that provides sales and inventory by store data back to your wholesale team. With that information, the wholesale partner can put together an order for Nordstrom to get the replenishment product in the doors that are inventory starved and those that are performing exceptionally well. Most retail partners, particularly where labor shortages exist, are very appreciative of getting this sort of help, which makes it a win-win situation. The better inventory is managed, the less excess there is to deal with at the end of the seasonal window, but there's always at least a little. In a perfect world, that excess is cleared through the company's internal channels. Those internal channels would either be the wholesale company's retail stores or e-com websites. These options are preferred over selling to jobbers because the likelihood of getting a decent margin is higher. The key to being able to sell within your own channels is making sure there is very little excess at the end of each season. Any inventory that goes beyond its seasonal window needs to be evaluated on a regular basis. Shipping delays can push some orders out of the window, but the retail partner remains committed to receiving the inventory. The sales team needs to actively communicate with the retail partner to make sure that is the case and set expectations as to when the inventory will ship. The second category of excess is inventory outside of its seasonal window without a sales order against it, but is otherwise not distressed. That means there are sufficient size runs and the inventory is not damaged. This is product offered first to the retail and e-com channels to sell, and then to value channel stores looking for supplemental inventory. The third category of excess is inventory outside of its seasonal window and is considered distressed. That means it's either size broken or damaged or irregular in some way. This is product that should be pushed to the jobbers as quickly as possible because it definitely won't get better with age. There are times where all the stars align and there is not sufficient clearance inventory to cover the amount of open-to-buy reserved by the retail and e-com channels. In these cases, the retail and e-com channels are allowed to utilize the Y-cut inventory, also known as speculative inventory, to meet their open-to-buy requirements. There are also opportunities to improve on the sourcing side. In the replenishment example provided earlier, the turn goal was 2, and our replenishment plan target was well above that. But that's not always the case. Many times, the replenishment target is much closer to the turn goal because the minimum order quantities are higher, forcing the company to purchase in larger increments and carry more inventory. When possible, the sourcing team should review the MOQs with the merchandising team's requirements to make sure the replenishment programs are managed as profitably as possible. With all of the delays COVID has brought us, the importance of choosing favorable freight terms is even more important. The important difference between FOB and DDP, the two freight terms primarily used, relates to inventory ownership. FOB is owned at the point it leaves the host country's port, while DDP shipments are owned when they are received in warehouse. When everything is working, that's about a 60-day difference between FOB and DDP, but carrier and port issues have more than doubled that difference. From a cash flow and profitability standpoint, that's a huge difference, and while these delays exist, sourcing teams should push for more of their shipments to be handled DDP. A concern related to DDP shipments is the loss of visibility because shipping arrangements are made by the factory or their agents, but those concerns are far smaller than they were even 5 to 10 years ago. Evaluating what happened at each season end is also very important, not only in addressing any lingering issues, but determining the best course to future seasons. When everything goes exactly as expected, communication with your retail partners is important, but in our current environment with delays and shutdowns, it's even more important. The end of every season should involve conversations between the retail partner and sales rep about what products worked and which ones did not, with an understanding of why to help make decisions on future assortments. Gross margin return on investment is one of the most important merchant metrics because the metric answers 3 questions. How much did we sell? How profitably did we sell it? And how much inventory did we have to carry to achieve those sales? The last question is the one most often overlooked when evaluating profitability, but it is important because allowing inventory to sit unsold in the warehouse reduces cash flow, the operational capabilities of your warehouses, and can destroy your profitability. It is a good idea to measure fashion and seasonal GMROI values separately from replenishment because replenishment programs require carrying inventory throughout the year, which makes their targeted GMROI much lower. Also, start your analysis at a category level and then drill down to look at the exception products that drove the GMROI higher and lower than the category GMROI value. While the targets may vary for your business, as a starting point we used 5 to 7 for fashion seasonal inventory, and between 2 and 3 for replenishment products. Where the GMROI value is outside of the targeted ranges, we need to understand why. Understanding the cause of the variance will determine how it should be handled. Understanding if the issue is related to the product or external factors will help you adjust your plans for future seasonal buys.
By sticking to the fundamentals of merchandising and making sure your lines of communication with your retail partners are open and active, it is possible for your organization to come through the current supply chain delays stronger than ever. Contact Enright-McPherran to help your organization maximize your operational efficiencies and profitability.